we bring in Bill Cohan, of course, Bloomberg contributing editor and the author of The House of Cards. Good of you to join us this afternoon.
Thank you, John.
Always good to see you. So, Michael Burry talking about Wall Street, the vicious place. I guess that's not something we haven't heard before.
No, that's pretty standard.
But from somebody who's made a lot of money on Wall Street over the last few years to call it a vicious place.
Well, look, you know, to make the kind of money that he made, that John Paulson made, you have to go against, you know, the conventional wisdom. And that's one thing that they did. And it turned out to be incredibly lucrative and incredibly successful. That's not easy to do, though. And that's Michael's point. And I think it's a very good one. If you try to buck the tide on Wall Street, you know, whether you're a short seller or whether you're trying to bet against the conventional wisdom, it's very difficult. They're not going to make it easy for you. But if you're right, well, then there's huge payoffs.
It does get to the question of, has Wall Street changed when it comes to being vicious versus friendly? Is it a friendlier place after the financial crisis, or is it the same old place?
Oh, come on. I mean, Wall Street has always been a very Darwinian place, always been, you know, as Felix Rohatyn said to me, you know, it's not a charitable organization. This is, you know, Wall Street is about making money. It's where the people who care about making money go to work, and they go there every day to make money. And in that game, you know, there's winners and there's losers. So if you're not one of the winners, you're one of the losers.
He's also somebody, obviously, who's talked about enjoying being far away from Wall Street, where he can just focus on his investments and stay away from the broad, you know, consensus on Wall Street. He called it a clubby place, which, again, is probably not a surprise. But, again, after the financial crisis, is it as clubby as before? Are they allowing others to join the party, per se?
Well, John, there are fewer people in the club, for starters, which makes it a lot better, probably, business for the firms that survived. Again, it's not a place where, you know, Wall Street is a big selling machine. So if you're not part of the selling, if you're a short seller or you're betting against the conventional wisdom or betting against the tide, they're not going to make it friendly for you, and they're not going to make it easy for you. One
of the other things is the hedge fund industry. Michael Burry was running a successful hedge fund, which he shut down in 2008 after, obviously, a lot of his investors were happy with his returns, and others said, we'd like our money back, thank you very much, and that frustrated him. But we're in a period right now where there are a number of high-profile hedge fund managers who are calling it quits, and he suggested that that could continue. What's your view on that?
No, I mean, absolutely. I mean, we're in a period of time where there's a lot of shakeout going on, just like there are a lot of, you know, investment banks that went by the wayside. I think the hedge fund 2 and 20, the private equity 2 and 20, that, you know, that was an incredibly great business, incredibly lucrative. Probably wasn't a better business known in the history of man than private equity and hedge funds with the 2 and 20. But now there's a shakeout because the returns just aren't where they were, and so inevitably you're going to have people who are going to exit that business. That's part of the creative destruction that is very common on Wall Street.
We actually talked about that model, that fee model, and he's, of course, someone who, from the get-go, when he started his hedge fund, and maybe that's because he always viewed things a little differently, charged differently. Do you get a sense that hedge funds are feeling pressure to throw out that model that has made them a lot of money in the last 10 years?
I think they're getting a lot of pressure now from their institutional investors. Absolutely. People like CalPERS and CalSTRS who are leading the charge in that area to cut those fees, and, you know, deservedly so. Why should they give these guys so much money and they're not going to get the returns that they could get, you know, if they invested, well, maybe not in treasuries, but in something treasury-like? I mean, why should they, you know, pay these guys that much money to do that? I think there are also some hedge fund guys, some private equity guys who are smart enough saying, hey, if I can cut my fees, I can attract a lot of capital to me. So there, you know, there's a lot of room in that 2 and 20 equation for new entrants to come in who offer the same quality of service with lower fees.
So, banks getting out of prop trading, a no-brainer, says Michael Burry, and of course, plenty of pressure from Washington. Were you surprised to see the developments that we're seeing with firms like Goldman Sachs, et cetera, as quickly as we've been seeing them?
Well, John, first of all, it's the law of the land, whether you agree with it or not, whether it makes sense, whether prop trading caused the crisis or not, which I happen to think it didn't, and I don't think there's much evidence that it did. But whether you believe it or not, it is the law of the land, and they have to comply. And so if you're Goldman Sachs, you know, it's better to end the uncertainty internally. I think that was the motivation here, to try to end that uncertainty internally for the people who are working there and get beyond it and get out of it if that's what they have to do.
You raise a great point. A lot of people are trying to figure out what is the most dangerous part of a Wall Street firm. Is it something like proprietary trading? Is it derivatives? Michael Burry would say it's not derivatives. If so, what is it? I mean, what is it that we should fear? on Wall Street?
Well, hopefully we don't fear them, but I think that what you have to fear about Wall Street is what we fear about human behavior. In other words, what the incentives are. If the incentives on Wall Street are to create new securities, new products, and then sell the heck out of them, that's what you have to be afraid of. That's what, Wall Street's very good at innovation, whether it's mortgage-backed securities, internet IPOs, high-yield securities, whatever it is. They're really good at creating new securities and being innovative, but then they're really good at selling without any corresponding, accountability for what they do. And when these firms changed from being private partnerships to public companies, accountability went out the window, and the incentives all were about generating revenue. And that's what we have to be fearful of. It's not the individual products per se, it's what the sales force, what the people do with the individual products once they're created and they're selling them. Because a lot of these individual products are actually great innovations that reduce the cost of capital for the people they're targeted at. I mean, there's no question that mortgage-backed securities reduce the cost of borrowing mortgages for homeowners.
Right.
And high-yield securities reduce the cost of borrowing for those companies that couldn't get access to capital before. So it's not the innovations, it's what happens after they're innovated that's the problem.
Well, what happens after some of these firms do officially get rid of their prop trading units? Michael Burry seems fairly skeptical about any real changes occurring. What would you say to that?
Well, I mean, look, what we never know with a firm like Goldman Sachs is just how profitable those businesses are, how big those are. Maybe as part of this sale process, we'll see this. But what we need to do, what they need to do and share with us,
right,
if they can, is what this means to their business.
Bill, thanks very much.